What if the global silver price you see on your screen isn't actually the price of silver anymore? For nearly a century, two institutions, Comex in New York and the London Bullion Market Association, have told the world what silver costs. Every mine, every manufacturer, every investor looked to these benchmarks. Their price was the price. But on December 24th, 2025, something broke. Silver traded at $78.49 per ounce on the Shanghai Gold Exchange. That same day, Comex futures closed at $72.36, an $8 premium. Think about that. The same ounce of metal, two different prices, separated not by transportation costs or tariffs, but by a fundamental disconnect in what the metal actually means. In Shanghai, silver is a physical commodity being consumed faster than it can be supplied. At Comex, silver is predominantly a paper contract that rarely triggers delivery. For the first time in modern history, the paper market and the physical market have truly diverged, and the gap is widening. Let me show you how we got here and why this pattern has appeared before with devastating consequences. The commodity exchange, Comex, was established in 1933 through the merger of four smaller commodity exchanges in New York. When the Bretton Woods system collapsed in 1971 and gold began floating freely, Comex positioned itself as the global benchmark for precious metals futures. Silver futures trading formalized in 1963, creating standardized contracts of 5,000 troy ounces each. The system worked through a simple premise. Buyers and sellers could lock in future prices without physically moving metal. Producers hedged against price drops. Manufacturers secured supply at known costs. Speculators bet on price movements. For decades, this paper market functioned because it remained tethered to physical reality. When futures prices diverged from spot prices, arbitrage corrected the imbalance. Metal flowed from surplus to deficit areas. The system equilibrated. Comex maintained credibility because, theoretically, every contract could trigger physical delivery from approved warehouses. By the late 1970s, Comex had become the dominant price-setting mechanism. When journalists reported the silver price, they meant Comex. When miners negotiated contracts, they referenced Comex. When central banks tracked precious metals, they watched Comex. The London Bullion Market Association reinforced this control through its settlement system. The LBMA developed unallocated account transfers between clearing members, allowing London to maintain pricing authority even when physical metal moved through other locations. Together, Comex and LBMA formed a global price discovery duopoly. Shanghai traded silver, yes. Tokyo had contracts, but London and New York set the price. This system required one critical element: sufficient physical inventory to validate the paper contracts. Comex warehouses held registered metal, silver with warrants attached, available for delivery. They also held eligible metal, stored privately but meeting exchange standards. The ratio between paper contracts and deliverable metal could stretch to 100-to-1 or higher during normal conditions. That worked fine when few contracts demanded delivery. Think about what this meant in practical terms. For every ounce of actual silver in Comex vaults, there might be 100 ounces worth of paper claims. The system functioned like fractional reserve banking. As long as only a small percentage of contract holders demanded physical delivery, the warehouse inventory sufficed. But what happens when everyone shows up to collect? The Hunt brothers discovered the answer in 1980. Nelson Bunker Hunt, William Herbert Hunt, and Lamar Hunt began accumulating silver in 1973 when prices sat at $1.50 per ounce. Over 6 years, they purchased more than 200 million ounces, valued at $4.5 billion. By late 1979, they controlled an estimated 69% of all Comex silver futures contracts. The brothers had borrowed heavily, using margin to finance their positions. They took physical delivery of their futures contracts, rather than rolling them forward or settling for cash. This was the trap. By demanding physical delivery, the Hunts exposed the fundamental imbalance between paper claims and deliverable metal. Silver prices exploded from $6.08 per ounce in January 1979 to $49.45 on January 18, 1980. A 713% increase in 12 months. On that same day, gold peaked at $850 per ounce. The silver to gold ratio compressed to 17-to-1, far below historical norms. Comex faced an existential crisis. Its warehouses held roughly 120 million ounces combined with the Chicago Board of Trade. The Hunts alone controlled claims to more metal than existed in approved storage. If other contract holders followed the Hunt strategy and demanded delivery, the exchange would default. On January 7, 1980, Comex implemented Silver Rule 7. This rule placed severe restrictions on margin purchases of silver futures. It reduced position limits from 5,000 contracts down to 2,000 contracts per entity. It increased margin requirements dramatically, forcing traders to put up nearly 100% cash instead of borrowing. Then, on January 21, 1980, Comex and the Chicago Board of Trade implemented liquidation-only trading. Contract holders could sell. They could not buy. New long positions were prohibited. Federal Reserve Chairman Paul Volcker simultaneously raised interest rates from 11.75% to 20%, making margin borrowing prohibitively expensive. He also encouraged banks to stop lending for precious metals speculation. The timing matters. Both silver and gold peaked on January 21, 1980, the exact day the liquidation-only rules took effect. Within days, silver prices began falling. By March 27, 1980, Silver Thursday, the price collapsed from $21.62 to $10.80 in a single session, a 50% loss in one day. The Hunt brothers couldn't meet their margin calls. They faced $1.7 billion in debt and threatened to take down multiple banks and brokerages. A consortium of U.S. banks provided a $1.1 billion emergency credit line to prevent systemic collapse. The official narrative blamed the Hunt brothers for manipulating the market. Certainly they contributed to the price spike. But here's what most people don't understand. Bullion market analysts who track the market in real time estimated the Hunts added perhaps 75 cents to $1 per ounce to silver's rise. The rest, the climb from $6 to nearly $50, reflected genuine monetary panic. An estimated 12 billion ounces of silver existed above ground in 1980. The Hunts controlled about 250 million ounces between physical holdings and futures contracts. That's roughly 2% of global supply. Warren Buffett would later hold 130 million ounces of physical silver between 1998 and 2006 without triggering similar intervention. The difference? The Hunts exposed the leverage problem by demanding delivery. They revealed that Comex couldn't actually deliver on its promises at scale. Think about what the system did in response. When the rules threatened those operating the system changed the rules. Comex moved from a free market to liquidation-only trading in a weekend. The Federal Reserve weaponized interest rates against a specific commodity. The message to precious metals traders was clear. You can participate, but only until your participation threatens control. The pattern established in 1980 set a precedent. When paper contracts diverge too far from physical reality, exchanges have the authority to intervene unilaterally. Fast forward to 2025. Silver prices have surged more than 120% during the year. By December 24th, spot prices globally approached $72 per ounce, extending a rally that pushed precious metals to record territory. Gold rose roughly 60% in the same period. But something different was happening in China. The Shanghai Gold Exchange, which operates the AG+D spot contract for physical silver, closed at 19,400 yuan per kilogram on December 24th. Converting to ounces in dollars, that's $78.49. Comex futures that day, $72.36, an $8.19 premium. By December 26th, Shanghai premiums had exceeded $8 per ounce consistently for days. This wasn't temporary basis fluctuation. This was sustained backwardation. Near-term prices trading above distant futures. Normally, backwardation resolves quickly through arbitrage. Silver should flow from Comex warehouses to Shanghai until prices converge. Except the metal isn't flowing fast enough. China accounts for more than 50% of global industrial silver demand, according to industry estimates. Solar panel manufacturing consumes massive quantities for photovoltaic cells. Electric vehicle production uses significantly more silver than traditional automobiles, particularly in power electronics and charging infrastructure. Each EV contains roughly 25 to 50 grams of silver. China produced over 9 million EVs in 2024. That's 225,000 to 450,000 kilograms of silver annually for EVs alone, equivalent to 7.2 to 14.5 million ounces. Defense electronics, grid expansion, and consumer electronics add to demand. By November 2025, silver inventories on Chinese exchanges had fallen to multi-year lows. The Shanghai Futures Exchange reported depleted stockpiles as domestic manufacturing absorbed available supply. This created immediate scarcity. When you need silver today to manufacture solar cells, you'll pay whatever it costs. The futures price months from now becomes irrelevant. Here's where the pattern echoes 1980. Comex maintains dominant trading volume and theoretically sets global prices. But that pricing authority depends on the ability to deliver physical metal when demanded. As long as most contracts settle financially or roll forward, the system works. When industrial buyers in the world's largest consumption market start pulling metal out faster than it can be replaced, the leverage problem reappears. Market analysis reveals silver futures backwardation extending to July 2028. Read that again. Backwardation extending 3 years forward. This suggests market participants expect supply shortages to persist indefinitely. Traditional price discovery mechanisms have broken. The inability of arbitrage to close price gaps reveals structural problems. Normally, traders would buy Comex silver at $72, ship it to Shanghai, and sell at $78. The $6 spread more than covers transportation and financing costs. Yet the premium persists. Several forces prevent normal arbitrage. First, export restrictions and supply chain constraints limit metal movement. Second, Western vault operators face their own inventory pressures. Available silver inventories globally have collapsed to approximately 200 million ounces of free float metal, according to industry estimates. That's down from significantly higher historical levels. Third, producing nations increasingly prioritize domestic supply security over international market stability. Peru and Mexico, major silver producers, have faced labor disputes and environmental regulations limiting output. Production bottlenecks reduce the flow of new supply. Fourth, a stronger yuan has increased the cost of importing silver into China, making domestic hoarding more attractive. But here's the deeper issue. The same mechanism that destroyed the hunts is now threatening Comex itself. Back in 1980, the exchange could change rules because the hunts were individuals trying to corner a market. In 2025, it's not speculators creating the squeeze. It's industrial demand from the world's largest economy consuming more metal than the paper market can deliver. Let's talk about what paper silver really means. When you trade Comex futures, you're not usually buying silver. You're buying a contract that references silver. Most contracts settle in cash. Traders speculate on price movements and close positions before delivery dates. Only a tiny fraction, often under 1%, actually demand physical delivery. This allows Comex to maintain the 100-to-1 leverage between paper contracts and vault inventory. The LBMA system operates similarly through unallocated accounts. When you hold unallocated silver, the bank owes you silver, but specific bars aren't set aside in your name. The bank maintains fractional reserves, assuming most clients won't demand physical all at once. Again, fractional reserve logic. The system tolerates leverage because participants agree to use paper as a proxy for physical. But industrial manufacturers can't build solar panels or circuit boards with paper. They need actual metal. When physical demand exceeds physical supply, the paper market becomes irrelevant. Think about yourself as a manufacturer in Shenzhen in December 2025. You have contracts to deliver solar panels. You need silver to produce photovoltaic cells. Comex says silver costs $72. But you can't get Comex silver delivered to Shenzhen quickly enough. Shanghai offers silver at $78 with immediate delivery. What do? You pay $78. The Comex price is meaningless to you. Now scale that across thousands of manufacturers. The Shanghai premium doesn't close because Chinese industrial demand genuinely exceeds available supply at Western prices. The physical market has decoupled from the paper market. Comex trading volumes surged to levels not seen since the October 2020 COVID rebound and February 2021's social media-driven silver squeeze. Friday, December 20th, 2025 saw Comex silver futures trading volumes beaten only twice since the 2020 crash recovery. Trading at the Shanghai Futures Exchange jumped to the highest level since May 2024 on December 23rd. Both exchanges showed frantic activity. But frantic paper trading doesn't create physical silver. The giant silver-backed ETF, SLV, grew 0.1% last week and expanded 3.1% for the month of December, the fastest monthly pace since June. Investors are piling into silver, yet investment demand competes directly with industrial demand for the same limited inventory. Every ounce bought by an ETF is an ounce unavailable for manufacturing. Mining companies can't increase output fast enough to satisfy both. Recent reports indicate specialized cargo flights have been chartered to move silver from US markets to London to cover shortages. The fact that moving 25 tons of silver, equivalent to 160 Comex contracts, via cargo flight adds minimal cost per ounce, yet these shipments have been delayed, highlights broader supply chain disruptions. London's pricing authority is failing. For decades, the LBMA benchmark served as the reference for transactions from New York to Asia. That authority depended on London's ability to settle transactions and deliver physical metal when needed. When London prices can't attract metal from surplus regions, when Shanghai trades at sustained premiums, when backwardation extends years into the future, the LBMA loses its grip. Some analysts warn that ongoing supply deficits could push silver to triple-digit prices in 2026 if production doesn't recover. But here's where it gets worse than 1980. Back then, Comex faced one entity demanding delivery at scale. The exchange changed rules and crushed the hunts. Today, Comex faces an entire nation's industrial base demanding physical metal. You can't change margin requirements on Chinese solar manufacturers. You can't implement liquidation-only rules on Shanghai spot contracts. The pressure isn't coming from speculators you can regulate away. It's coming from structural supply-demand imbalance in the real economy. Geopolitical factors amplify the squeeze. Rising defense spending linked to conflicts in Ukraine and the Middle East has increased demand for silver in military electronics and munitions. Unlike investment silver, this metal is consumed permanently. It doesn't return to circulation. The energy transition accelerates demand. Every solar panel installation pulls silver from available supply. Every EV manufactured removes silver from the market. These aren't cyclical demands that ebb and flow. They're secular trends supported by government mandates and climate policies. China's industrial policy prioritizes domestic solar and EV production. That means Chinese buyers will secure silver regardless of price. The Shanghai premium reflects that determination. What happens next? The pattern from 1980 offers clues. When paper markets face delivery crises, authorities intervene. But the intervention playbook designed for individual speculators doesn't work against sovereign industrial policy. Comex could theoretically raise margin requirements. That won't stop Chinese manufacturers from buying physical metal in Shanghai. Comex could limit position sizes. That won't create new silver supply. The Federal Reserve could raise rates. That might slow investment demand, but won't reduce industrial consumption. Here's the critical question. If Shanghai consistently trades at $8 plus premiums and Comex can't close that gap, which price is real? If you're a mining company negotiating supply contracts, do you reference the paper price at Comex or the physical price in Shanghai where actual demand exists? If you're a central bank tracking precious metals reserves, which benchmark represents value? The divergence suggests a fundamental repricing is underway. For over 90 years, Western financial institutions have controlled precious metals pricing. Comex and LBMA set benchmarks that the world accepted. But that control depended on their ability to deliver physical metal at the prices they quoted. When the world's largest industrial consumer can't get metal at Comex prices and bids up Shanghai prices instead, control shifts. Think about the timeline. Silver futures backwardation extending to July 2028 means markets expect Shanghai premiums to persist for years. That's not a temporary squeeze. That's a structural break. The pattern says this doesn't resolve without either massive new supply or demand destruction. New supply requires years to develop. Major mines can't spin up overnight. Demand destruction requires either economic recession or technological substitution. Neither appears imminent. So let's connect all the pieces. In 1980, Comex maintained control by changing the rules when the Hunt brothers exposed excessive leverage. The system survived because regulators could override market forces through trading restrictions and interest rate manipulation. The paper market regained credibility. Participants accepted that Comex prices reflected silver's value. For 45 years, that paradigm held. Now, in 2025, a different challenge has emerged. Industrial demand in China exceeds what the paper market can deliver. Shanghai trades at sustained premiums to Comex. Backwardation extends years forward. Arbitrage can't close the gap. This isn't speculators gaming the system. This is the physical market asserting primacy over the paper market. The fundamental question facing Comex is whether a futures exchange based in New York can continue setting global prices for a commodity when the world's largest consumer operates in a different price regime. History shows that price discovery migrates to where genuine supply and demand intersect. When London dominated the 19th century, London set prices. When New York's financial markets surged in the 20th century, New York set prices. In the 21st century, if China consumes over 50% of industrial silver and Chinese buyers determine how much they'll pay, does pricing authority flow east? The Hunt brothers tried to corner silver and failed because they fought the Federal Reserve and Comex. Chinese industrial policy isn't trying to corner anything. It's simply consuming silver faster than Western markets can supply it at Western prices. The Hunts could be crushed by leverage. You can't crush industrial demand with margin calls. The pattern established in 1980, that authorities will intervene to protect paper market credibility, may not work this time. The tools that destroyed speculators don't work against structural supply shortages driven by sovereign industrial policy. Available inventory has fallen to critically low levels. Production can't increase fast enough. Industrial consumption continues accelerating. Investment demand adds pressure. And Shanghai keeps trading at premiums that suggest Chinese buyers don't care what Comex says silver costs. We're not living in a world shaped by paper contracts anymore. We're living in a world where physical scarcity increasingly determines price. And the paper markets that claimed price-setting authority for a century are losing control. The Shanghai premium isn't noise, it's signal. It's the market saying that Comex futures no longer represent the true cost of owning silver when you actually need the metal. The only question is how long Comex can maintain the illusion that its price is the price, when Shanghai proves otherwise every trading day. The evidence says the divergence will widen before it resolves. And when it resolves, the entity setting global silver prices may not be in New York anymore.